The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled Climate Risk, Are Financial Regulators Politically Independent? Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I now recognize myself for 4 minutes to give an opening statement. Federal regulators represented here today have recently coordinated to promulgate principles for managing climate-related financial risks. The guidance and information requested by the regulators align with a 2021 executive order, efforts promoted by the Financial Stability Oversight Council, Chair Yellen, and recommendations from various international global governance organizations. The Federal Reserve is extending furthest with a mandatory supervisory climate scenario analysis and formal collaboration with Treasury's Office of Financial Research on climate data and analysis, which the Board of Governors never voted to approve. FSOC Chair Yellen has repeatedly identified climate change as an existential crisis and has called climate change, quote, an emerging and increasing threat to financial stability, unquote. Following the administration's posture on climate-related financial risk, regulators have begun inserting climate policies into bank regulation and supervision. There is little transparency about regulators' climate efforts and what occurs in administration-led climate working groups or international global governance organizations. 4 bills have been attached to this hearing to address this lack of transparency and regulatory capture. There is also lack of transparency about funding of some of the climate-related efforts of the international organizations, including the tangled web of financing associated with the network of central banks and supervisors for greening of the financial system, or NGFS. There is nothing wrong with regulators wanting to learn more about data methods and analysis or to ask questions of banks about what they're doing. No one believes that financial institutions should ignore not fully understood risks. But we and the regulators know that institutions are already analyzing climate-related financial risks, and many large institutions have public-facing information available describing how they are monitoring and managing this risk. Yet somehow, after an executive order was issued and FSOC made pronouncements, the regulators found a sudden need for a coordinated public-facing campaign of guiding principles for climate risks that research says are manageable. Regulators are saying that their efforts are intended to help banks manage risks that are not yet fully understood, even by the regulators, with the underlying premise that somehow the prudential regulators know better than the private sector. That seems odd, given that the Fed says that they must exercise humility about spotting risks, and they couldn't even help institutions manage interest rate risks. The Fed's vice chair for supervision promises, as he did with Silicon Valley Bank's failure, to write a public-facing report of his personal assessment of what his climate scenario analysis reveals, using data that Congress will not be able to see to corroborate his findings. At best, existing climate-related financial risk analysis can show long-run directionality of financial and economic effects of alarming climate futures. But to think that existing analyses can accurately predict near-term effects of projected climate changes 5, 10, or even 100 years out is misleading and false advertising. Climate models are typically unwieldy mongrels characterized by cascading uncertainties as they mix and match inputs and outputs from economic, climate, ocean temperature, and other modules to produce questionable numbers with highly questionable predictive content. There are so many degrees of freedom available to climate analysts that, like cooking soup with a cabinet full of spices, you can get whatever flavor of results that you'd like. As Nobel Prize-winning economist Lars Peter Hansen counsels to regulators and central banks, quote, their credibility will be further enhanced by avoiding the temptation to exaggerate our understanding of climate change, unquote. On climate policy, driven by Biden administration directives, regulators are choosing politicized policymaking, putting their independence at risk and giving in to the temptation to exaggerate our understanding of climate change. The chair now recognizes the ranking member of the Subcommittee on Financial Institutions and Monetary Policy, the gentleman from Illinois, Mr. Foster, for 4 minutes for an opening statement.
Thank you, Chair Barr, and thank you to our witnesses for being here today, and thank you to our regulators for appropriately and thoughtfully responding to the changing risk profiles of our financial systems. As our world changes, it's important that participants in our financial system remain well apprised of new and emerging risks, and it's important that our regulators help them stay well postured for those risks. History tells us that systemic financial risks do not come from politically driven overreaction to emerging risks, but rather from regulatory capture, properly defined, which is the use of the political power by economic incumbents who use their political power to restrict the ability of regulators to respond to new and real financial threats that powerful incumbents may find inconvenient to acknowledge. We saw that most recently in the financial collapse of 2007, which was preceded by more than 20 years of great moderation, a period lasting from about 84 to 2008, a period of low volatility and continuously rising asset prices, including home prices that rose faster than GDP, but also a banking system and a middle class that became leveraged beyond all reason, and an economy completely dependent on continuously rising asset and real estate prices, which was obviously unsustainable from first principles, just as it is scientifically unsustainable to continue putting greenhouse gases into our atmosphere without suffering severe economic consequences. However, in 2007, as well as many times in our history, the political power of economic incumbents encouraged or forced regulators to keep their heads in the sand. So instead of appropriately responding to what was then euphemistically called the subprime crisis as the tip of a much larger iceberg of systemic risk, in 2008, the Bush Treasury Department put out a blueprint for financial modernization, which incredibly proposed even further deregulation of an already shaky financial system. So the threat of political influence on our financial regulators is real. And climate change does pose systemic risks to our nation's financial system. The destruction waged by stronger hurricanes and tornadoes, more intense floods and droughts, sea level rise and wildfires threatens businesses, banks, and credit unions across our country. And when a large swath of a region's businesses or homeowners face major losses all at once, from one of these catastrophic weather systems, financial institutions that issue loans or insurance to them, in turn, must swallow large losses. And to maintain system-wide stability, the regulators must ensure that banks are able to weather these literal and figurative storms. Similarly, on the investor level, in order to effectively manage their own risks, shareholders must have access to information regarding a company's exposure to climate-related risks. We cannot allow Americans to lose their retirement savings because acknowledging the realities of climate change has been overshadowed by partisan politics. Federal financial regulators, including the SEC, have recently promulgated regulations to address system-wide and investor-level risks, and I applaud them for doing so. My Republican colleagues seem to have called this hearing to promote the idea that regulations represent a lack of political independence by the agencies, that they're responding to Democratic pressure to raise the alarm about the impacts of climate change. However, the true danger lies in the other direction, in a politically driven underreaction. And these rules simply recognize the reality of climate risk to our financial system. If hearings like this one end up pressuring regulators to bury their heads in the sand and ignore climate risks, it would create a grave economic distortion and risk unnecessary failure of our financial institutions and harm to ordinary Americans that inevitably follows. So I applaud FSOC and the SEC for following the science and considering the financial risks posed by climate change in spite of the political pressure. And I look forward to hearing from our witnesses today to show how we can further increase transparency and mitigation surrounding financial institutions' climate risk.
The gentleman's time has expired. The chair now recognizes the chair of the Subcommittee on Oversight and Investigations and leader of the Environmental, Social, and Governance Working Group, the gentleman from Michigan, Mr. Huizenga, for 1 minute.
Thank you, Mr. Barr. Appreciate you allowing me to attend. And well-intentioned but misguided government mandates are nothing new in Washington. However, the radical shift by this administration to pound ESG policies into every facet of our society outside of the legislative process has reached a critical breaking point. As banking regulators continue to push for the disclosure of climate-related information of which they have little or no experience with, small businesses as well as low- and middle-income families across the country continue to be crushed by soaring costs stemming from President Biden's failed economic agenda. Instead of feeding their obsession to become climate policy makers, often picking winners and losers, regulators should focus on sound banking policy that won't impede America's drive for energy independence and increased economic opportunity for all. Republicans won't idly stand by and allow banking regulators on their own to channel credit to politically desired sectors, bypassing Congress. So thank you, Mr. Chairman, for allowing me to join your subcommittee, and I look forward to hearing from the witnesses.
The gentleman yields back. The gentlelady from California is not here, and so we will move on to a witness testimony. Today we welcome the testimony of Mr. Greg Coleman. Mr. Coleman is the Senior Deputy Comptroller for Large Bank Supervision at the Office of the Comptroller of the Currency. Ms. Doreen Eberley. Ms. Eberley is the Director of the Division of Risk Management and Supervision at the Federal Deposit Insurance Corporation. Dr. Michael S. Gibson. Dr. Gibson is the Director of the Division of Supervision and Regulation at the Board of Governors of the Federal Reserve System. Mr. Rendell L. Jones. Mr. Jones is the Deputy Executive Director at the National Credit Union Administration. And the Honorable Sarah Benatar. Ms. Benatar is the Treasurer of Coconino County, Arizona. Welcome to Washington. Thank you for being here. Thanks to all of you for your service and for taking time to be here. Each of you will be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, each of your written statements will be made part of the record. Mr. Coleman, you are now recognized for 5 minutes to give your oral remarks.
Chairman Barr, Member Foster, and members of the subcommittee, thank you for the opportunity to appear today to discuss the Office of the Comptroller of Currency's activities around climate-related financial risk. The OCC is an independent bureau of the Department of Treasury, and its mission is to ensure that national banks and federal savings associations operate in a safe and sound manner, provide fair access to financial services, treat customers fairly, and comply with applicable laws and regulations. Consistent with that mission, one of the OCC's current priorities is acting on climate risk due to the increased frequency, severity, and volatility of weather events which affect the value of financial assets, borrowers' creditworthiness, and the associated risks banks may take onto their balance sheets. Our focus for this priority is on the largest banks. I'd like to stress that the OCC does not and will not tell bankers what customers or legal businesses they may or may not bank. Rather, we are committed to staying focused on banks' risk management of climate-related financial risks. This focus is firmly rooted in our mandate to ensure that national banks and federal savings associations operate in a safe and sound manner. The OCC has approached climate-related financial risks the same way the agency approaches any emerging risk area, to work with our regulated institutions to determine if they have appropriate processes and procedures in place to address the risk. In December 2021, the OCC issued for public comment draft principles designed to support the identification and management of climate-related financial risks at OCC-regulated institutions with more than $100 billion in total assets. Limiting the scope of the guidance to large banks, which have already begun to monitor this emerging risk, is intentional because their exposures to climate-related financial risk may be material. The draft principles describe general considerations relating to bank governance, policies, procedures and limits, strategic planning, risk management, data, and other areas. They provide considerations for how climate-related financial risk can be addressed in the traditional risk categories, including credit, liquidity, operational risk, and others. The agency has invited feedback on all aspects of the draft principles, and we are continuing to work and continue to consider the comments received. We are working with our interagency colleagues to determine the next steps in this area. On their own initiative, large banks have begun incorporating climate-related financial risks in their risk management frameworks and policies. To understand their climate-related financial risk management programs, the OCC began reviewing this information in 2022. My testimony describes our initial observations from these reviews. In general, the large banks we supervise are in varying stages of developing processes to measure and monitor their potential exposures to physical and transition climate-related financial risks. I stress that community banks are not the focus of our climate-related financial risk efforts. Based on decades of experience in their local communities, community bankers are very familiar with the impacts of weather events upon their customers and business. Further, these banks have long managed the risks that localized weather events present. The OCC does not intend our efforts aimed at the large banks to trickle down to community banks. However, Acting Comptroller Sue has suggested that mid-size and community bankers be mindful of these risks and give thought to how they can continue to manage them appropriately. To ensure that the OCC is aware of the climate-related financial risk management efforts of other federal government and international bodies, the agency is a member of the Financial Stability Oversight Council's Climate-Related Financial Risk Committee. We also participate in the Basel Committee on Banking Supervision Task Force on Climate-Related Financial Risks and the network of central banks and supervisors of greening the financial system. Our efforts with these international bodies allow the OCC to ensure awareness of and facilitate information sharing with our fellow regulators. In closing, the OCC is committed to assessing climate-related financial risks at banks with over $100 billion in consolidated assets from a risk management perspective. This approach is consistent with how the agency responds to emerging risks to the banking industry and to ensure that national banks and federal savings associations continue to remain safe and sound, provide fair access to credit, and treat customers fairly. Thank you, and I'll be happy to answer your questions.
Thank you for your testimony, Mr. Coleman. And Ms. Eberley, you are now recognized for 5 minutes to give your oral remarks.
Thank you, Chairman Barr, Ranking Member Foster. and members of Congress, on the issues outlined in my testimony. I look forward to answering your questions.
The gentlelady yields back, and now the chair recognizes Dr. Gibson for his oral remarks.
Chairman Barr, Ranking Member Foster, and members of the subcommittee, thank you for the opportunity to discuss the Federal Reserve's supervisory work related to the financial risks of climate change. The Federal Reserve's responsibilities with respect to climate change are important but narrow. These responsibilities are tightly linked to our responsibilities for bank supervision and financial stability. Because climate change could pose challenges for the financial system, it is important that we better understand these risks. Our primary focus is to evaluate whether banks operate in a safe and sound manner and manage all material risks, including climate-related financial risks. Before proceeding, it is important to emphasize two general points about our supervisory approach. First, the Federal Reserve recognizes that decisions about policies to address climate change itself should be made by the elected branches of government. As Chair Powell stated earlier this year, the Federal Reserve is not a climate policymaker. Second, it is not the Federal Reserve's policy to discourage banks from offering accounts or services to any class or type of law-abiding business, and this is not a part of our work looking into climate-related financial risk. Our supervisory work related to the financial risks from climate change is based on our core responsibility to ensure that banks understand and appropriately manage all material risks, including any related to climate change. Weaknesses in how banks identify, measure, monitor, and control climate-related financial risks could adversely affect a bank's safety and soundness. To fulfill this supervisory responsibility, the Federal Reserve is working to better understand the potential implications of climate change for supervised banks. I will now briefly discuss two near-term supervisory priorities for the Federal Reserve related to the financial risks of climate change: issuing interagency guidance for large banks and conducting a pilot climate scenario analysis exercise. Last December, the Federal Reserve asked for public comment on draft guidance providing a high-level framework for the safe and sound management of exposures to climate-related financial risks for large banks. The guidance would apply only to banks with over $100 billion in total consolidated assets. The proposed guidance contains high-level principles and describes how climate-related financial risks can be addressed in specific prudential risk areas. We intend to coordinate with the OCC and FDIC in issuing any final guidance to promote consistency across supervision of large financial institutions. Climate scenario analysis, in which the resilience of financial institutions is reviewed under different climate scenarios, is an emerging risk management and supervisory tool used to evaluate climate-related financial risks. The pilot climate scenario analysis launched in January was designed with two objectives: to learn about large banking organizations' climate risk management practices and challenges, and to enhance the ability of both large banking organizations and supervisors to identify, measure, monitor, and manage climate-related financial risks. I should emphasize that we view climate scenario analyses as distinct and separate from the Federal Reserve's supervisory stress test. The Federal Reserve's stress test is designed to assess whether large banking organizations have enough capital to continue lending to households and businesses during a severe recession and financial market shock. The pilot climate scenario analysis exercise, on the other hand, is exploratory in nature and does not have consequences for bank capital or supervisory implications. As I mentioned earlier, the Federal Reserve's role with respect to climate change is important but narrow. The Federal Reserve has a duty to understand risks to the safety and soundness of the banks it oversees and to the financial system, including the financial risks from climate change. Thank you. I look forward to your questions.
Thank you. And now, Mr. Jones, you're recognized for 5 minutes.
Good morning, Chairman Barr, Ranking Member Foster, and members of the subcommittee. Thank you for inviting the National Credit Union Administration to discuss the agency's activities regarding climate-related financial risk. My name is Rendell Jones, and I'm the Deputy Executive Director for NCUA. As a regulator and insurer, the NCUA is responsible for examining and supervising for credit union resilience against all material risks. the agency believes that credit unions are best positioned to assess various risks, including climate-related financial risks, and opportunities within their specific fields of membership. In my testimony, I will summarize NCUA's recent voluntary request for information. In late April, at a public meeting of the NCUA board, the NCUA issued a request for information, or RFI, seeking input from stakeholders and subject matter experts to strengthen the agency's ability to identify and understand credit unions' current and future climate-related financial risks. The NCUA's goals in issuing the RFI are twofold. First, the agency seeks to improve its understanding of climate-related financial risks, how credit unions view them, and how it can best support the industry in mitigating them. And second, the agency aims to better understand the products and services credit unions can offer to leverage opportunities presented by any related transitions in key economic sectors. In the NCUA's RFI, the agency requested voluntary feedback and included 38 questions for the public's consideration. It solicited input on a variety of topics, including climate-related physical and transition risks that are affecting or may affect the industry in the future, potential adjustments to operations, governance, and business strategies to mitigate those risks, and methods, metrics, and tools for identifying and measuring those risks, and climate-related business opportunities, including the support needed to expand products and services and any barriers that credit unions might face. The comment period closed on June 26th, and the agency received 44 responses from individual credit unions, credit union trade associations, and other interested parties. Insights derived from the responses provided by stakeholders will be essential in shaping any future efforts in this area. As noted in the RFI, NCUA does not plan to use the information collected in the examination and supervision of individual credit unions. Any new requirements for credit unions associated with climate-related financial risks would require changes to existing examination and supervision procedures and approval by the NCUA board. The credit union system remains well capitalized, stable, and well positioned to handle various economic possibilities. The NCUA continues to monitor for any material risks, including climate-related financial risks, to credit union performance and the health and stability of the National Credit Union Share Insurance Fund. Thank you for the invitation to testify before you today, and I look forward to answering any questions you may have.
Thank you. And Ms. Benatar, you are now recognized for 5 minutes.
Thank you, Mr. Chairman, Ranking Member, and distinguished members of the House Financial Services Committee. My name is Sarah Benatar, and I serve as the treasurer of Coconino County, Arizona, the second largest county by area in the country. In addition to this, I am president of both the Arizona Association of Counties and the National Association of Hispanic County Officials. As treasurer, I serve as the bank and chief investment officer for the entire county, responsible for the safekeeping of public dollars on deposit with us, from county departments to all special districts such as schools and fire districts. My fellow county government officials across the country spend days and nights worrying about potential risks that would cost taxpayers money and could jeopardize our ability to pay for the hardworking first responders, road crews, and other public servants in our communities. In managing public funds, it's important to always put the safety of public dollars first, followed by addressing liquidity needs, and lastly, working towards a positive rate of return. In short, safety first, then liquidity, then yield. This necessarily includes considering all forms of risk, including climate risk. These priorities ensure that we are the best stewards of public funds. Unfortunately, we are seeing a national trend that jeopardizes our top priority to ensure the safety of taxpayer dollars. Across the country, legislation is being introduced that will reduce the universe of banks with whom our Treasury can do business with, what we can invest in, and what policies we can adopt to evaluate risk associated with public fund management. Many of these proposals claim to want to depoliticize financial regulations, but instead embed new political tests that protect special interests from market competition. Furthermore, when rubber meets the road in implementing these bills, they raise costs to our taxpayers. Every jurisdiction needs a servicing bank. The free market RFP process is vital to ensuring the protection of taxpayer dollars, but it only works if there are sufficient bidders for a free market to exist. Responses to government RFPs are already limited due to collateralization and asset requirements, with only a handful of banks even servicing governments. Simply put, an anti-ESG legislation will push numerous bidders out of the process entirely. At best, local governments will be left with one option to select from and would suffer from higher cost. At worst, we would receive no bids, leaving us without a servicing bank and changing local governments as we know it. How will I pay my firefighters who are on multi-weeks assignments if I can't do direct deposit because we don't have a bank? This reduction in size of the market for public banking services is a reality, not hypothetical, for local governments and states where anti-ESG legislation has passed. In addition to servicing bank needs, treasurers are responsible for the investment of public funds. The foremost objectivity in government investing is the safety of principal. This means mitigating and evaluating risk of investment decisions in both the short term and long term. As a prudent fiduciary, I believe that climate risks are part of that analysis of safety that must be considered to honor my duty of care and duty of loyalty. Over the last year alone, my county has faced numerous wildfires, flooding events, tornadoes, record snowfalls, and now record heat levels. When determining whether to invest in a corporate bond, I should have the ability to evaluate the risk of that investment by asking questions like, is a major distribution center of this company in a disaster area? Safety of public funds is about evaluating risk with all the tools in our toolbox. It is up to us as prudent local investment officers to decide which tools we want to use. These concerns are shared by local officials across the country, regardless of party. We want what is best for our communities. We want to keep taxpayer money safe. We want free markets so that we can get the best value. We want the ability to make choices ourselves in who we do business with and how we invest our public dollars. There is no better illustration of this than the bipartisanship between the county treasurers in Arizona, who have stood together to oppose legislation that will jeopardize our abilities to be good stewards of public dollars. I urge you to listen to the dedicated public servants who are elected by communities within your districts, to the associations of businesses who have spoken out against these measures, and to the average citizens who just want their taxpayer dollars protected. Thank you for your consideration.
Thank you. And we'll now turn to member questions. The chair now recognizes himself for 5 minutes for questioning. Dr. Coleman, in your testimony, you quoted Chair Powell saying that the Federal Reserve is not a climate policymaker. You also said that it is not and never has been the Federal Reserve's policy to discourage banks from offering accounts or services to any class or type of law-abiding business, and this is not part of our work. Mr. Coleman, you, in your testimony, said that the OCC does not and will not tell bankers what customers or legal businesses they may or may not bank. And Ms. Eberley, in your testimony, fortunately, you pointed out that the FDI will not be involved in determining firms or sectors with which financial institutions should do business. These types of credit allocation decisions are responsibilities of financial institutions. What this hearing is going to be about, though, is why members of Congress and market participants and banks and their customers are skeptical because of these assurances. Because Dr. Coleman, when you say this climate scenario analysis exercise that the Fed is undertaking will not have consequences for bank capital or supervisory implications, what we say is not yet, at least not yet. We want to know where this is going. And so to that end, we want to talk, Dr. Gibson, first about what the Fed is doing as part of the NGFS. And let me just start with Mr. Coleman, actually. Mr. Coleman, can you tell me about what the OCC knows about funding at the network of central banks and supervisors for the greening of the financial system, including who funds work on climate analysis? And in your answer, can you specifically address this group called the International Network for Sustainable Financial Policy Insights, Research, and Exchange, or INSPIRE?
Thank you for the question. am not aware of the funding structure for these organizations. The OCC participates in these organizations along with several other international and domestic regulatory bodies in order for us to share information and learn from them on a variety of emerging risk issues.
Dr. Gibson, can you answer the same question about what the Fed knows about NGFS funding and about the involvement of INSPIRE or the pass-through funding organization Climate Works?
Yeah, I also don't know anything about the funding of the NGFS. We do participate in their meetings and in their working groups.
Well, if there is involvement of Climate Works in funding NGFS, climate models, data scenario analysis, and the like, would the Fed have concern about politics creeping into your climate work, given that the current senior advisor to President Biden for clean energy innovation and implementation had for years been an influential member of the board of Climate Works, which at least in 2021 held more than $430 million in assets to distribute for environmental activist grant making?
So we participate in these international groups in order to learn from our foreign counterparts and participate in the discussions around international standards. But that's the extent of it.
Well, to Mr. Coleman, Ms. Eberley, and to Dr. Gibson, how many meetings have there been between officials and employees of your agencies and the NGFS since January of 2021?
I do not have an answer to the specific number of meetings.
I don't know the number either.
Yeah, I don't know the exact number. We do participate in their meetings.
Well, how many people are you dedicating to traveling to these meetings with NGFS?
I don't think we have anyone dedicated just to the NGFS, and most of the meetings are virtual.
Well, can any of you describe, besides just discussing and listening, what other work are you doing with this international body, NGFS, and where can we find an accounting of that work?
So the NGFS publishes on their website their work plan and all their work products, so I think everyone has access to the work that they're doing.
Are there NGFS workstream papers or models? I guess let me just, in my remaining time, let me just get to the point. Members of Congress and the American people are very concerned about the extraterritorial reach of this opaque, you all can't even answer these questions, this opaque, mysterious international body that apparently is influencing the agencies that are regulating our banks. So not only is there an opacity with what's going on here, we have this international body that is potentially impacting decision-making. And what we're worried about is where this is going, to have an international body influencing regulators to pressure financial institutions, maybe not now, but eventually to force them into credit allocation decisions that are entirely inappropriate. So with that, my time has expired, and I'll recognize the ranking member of the full committee, Ms. Waters from California, for 5 minutes.
Thank you very much. Mr. Benatar, Treasurer Benatar, while House Republicans are focusing on federal regulators of banks and credit unions, Democrats thought it was important to have additional local government perspectives on what anti-ESG attacks mean for their banking relationships. I understand that earlier this year, you led a letter signed by Democrat and Republican county treasurers in your state opposing anti-ESG legislation that would have limited the ability of certain banks and others to do business in the state of Arizona. What would the impacts of this legislation be on your county and on your work as a county treasurer? Have you heard similar concerns from other local or state treasurers in other parts of the county?
We have heard from other states that have passed these anti-ESG legislations that it has increased their costs and it has also reduced the number of companies they can do business with. So my role as president of the National Association of Hispanic County Officials has allowed me to connect with my colleagues across the country. And studies are also have come out that are saying the same exact thing. You look at Texas, it's going to result in billions of dollars, and right now they're paying an additional $300 to $500 million just to do bonds in their state. You look at Florida. Florida has a higher rating than California, yet they are paying higher interest rates due to anti-ESG legislation that are passing. So that was a concern of ours in Arizona because we are very limited in who we can do business with right now. And reducing the number of financial institutions that we can work with will have dire consequences within our communities and will cost our taxpayers money.
Can you give us some insight on what has been alluded to here today about pressure that's being placed on banks and or financial institutions from these foreign entities worldwide, et cetera? What do you know about that?
So I have a fiduciary duty. I have a duty of loyalty to the residents of my county. And for me, the most important thing is the public safety of our dollars. Not just for today, but for generations to come. In doing that, I have to look at best practices. And that includes things like climate risk analysis in my decision making. That includes looking at regulations. That includes being able to find the information so I am analyzing risk to the best of my ability. And this is also noted by nonpartisan organizations for government financial managers across the country. So I need to be able to easily access that information, including climate risk, when I'm evaluating my investment decisions, but also my cash flow analysis. So although I may not know the information necessarily about the international groups, I do know that there are best practices out there that I do need to follow in the work I do.
You've alluded to your fiduciary responsibility. And in alluding to that, what you're saying is you must take into consideration all of the possible risk, et cetera, as you make decisions. Do you have any further comments about fiduciary responsibility? Because that's very, very key when we're dealing with our financial institutions, our banks, et cetera.
Thank you. No, that is the number one priority of mine, and it is the number one priority of government officials across the country. And for us in local government, safety will always come first, then liquidity, then yield. And for me, climate analysis and climate risk is real. In my community, we have been facing fires and flooding for well over 10 years. Without using and including climate analysis in my day-to-day work, I would not have the cash flow available to be able to free up the money, not just for my fire district for a fire, but for the 20, 30, 40-year flooding events we will now be having. And that also means in my investment portfolio management, I need to make sure I'm considering that as well. So for me, safety will always come first because taxpayer money is at stake.
Well, I thank you for that very profound information. As you know, I'm from California, and we've had fires that unprecedented in the state of California. So I hope that you in Arizona, California, and other states that are experiencing these kinds of devastated natural causes, that you will have the kind of information that you need to help people understand exactly what is going on with climate risk.
Gentlelady's time has expired.
very
The
much.
gentleman from Florida, Mr. Posey, is now recognized.
Thank you very much, Mr. Chairman, and I thank all the witnesses for your testimony and your time to appear before us this morning. At the Financial Stability Oversight Council hearing before the Senate Banking Committee just about a year ago, Senator Toomey asked Secretary Yellen if there had been a single failure of a financial institution as a result of a severe weather event. She acknowledged that she wasn't aware of such a failure. Can any of you identify an example where a flood, hurricane, or wildfire has resulted in a financial institution's failure? I will start, I guess I'll like to ask each of you to answer. We'll start with Secretary Benatar and come across.
I will personally say that in terms of financial institution, I do not know any knowledge, but I do want to point out that
You answered my questions. Thank you. Mr. Jones?
Yes, there were 2 credit unions that failed as a result of the impact of Hurricane Katrina, one causing a loss to the Share Insurance Fund of about $500,000.
Okay. Mr. Gibson?
Not aware of any bank failures that can be attributed directly to climate change.
Eberley?
The same answer, no failures attributed to climate change or weather events.
The same answer, I'm not familiar with any bank failures related to weather events.
Experts tell us there are two kinds of climate-related risk. Natural risk that I just asked you each about, and the risk to financial positions for transitioning away from things like fossil fuels to other energy sources. Can you please give a clear, concise example of a credible, material, and imminent financial risk of climate change that warrants the government's imposing a climate risk management discipline on financial institutions and at the expense of climate scenario analysis at this time? And we'll start with you, Mr. Coleman.
Thank you for the question. I would start with a physical risk. So, for example, you could have an institution that relies upon the collateral value of some type of property. That property was impacted by a climate-related financial risk, could impact the value of that collateral. That could also impact the ability for that property to cash flow, which could then impact the value of that asset to the institution.
Thank you. Ms. Eberley?
Institutions have relied on insurance to mitigate the risks of weather events, and institutions are now experiencing, and their borrowers are experiencing, increasing costs of insurance, and that affects how institutions underwrite loans to make sure borrowers can continue to repay in the future, and also rely on the value of the collateral pledged, if any. So that's been one impact, and then insurers pulling out of states have generally contributed to the increasing costs, where insurers don't want to take the risk because of the increasing severity or frequency of weather events.
Thank you. Very good. Mr. Gibson?
Another category of climate risks is transition risks. Those are risks from changes in market sentiment or consumer preferences or policy technology that affect that are driven by climate change. So, for example, if a borrower has a concentration in a particular technology that becomes obsolete because of changes due to climate change and new technologies, that could be a risk to a bank's creditworthiness.
Thank you. Mr. Jones?
So what I'd add is I agree with Ms. Eberley's comment regarding insurers pulling out of certain states and making the costs of owning a home much more expensive, and credit unions have reported to us that they are seeing that. The other thing I would add is we've also seen not just the risk side, but the opportunity side, and credit unions being very resilient in responding to the needs of their membership have designed certain consumer loan products specifically targeting green energy products and the like, and so we've seen the business opportunity side of that as well.
Thank you very much. Treasurer Benatar?
On a local level, it impacts our budgets. It will result in significant increases to our expenditures, which means that we need to make sure cash is available without actually selling bonds at a loss or investment positions at a loss to free up the money, which ultimately results in increases to our taxpayers.
Thank you all very much. Mr. Chairman, time is about to expire, so I yield back.
Gentleman yields back. The gentleman from Illinois, Dr. Foster, is now recognized.
Thank you. Now, I guess I'll start with Dr. Gibbs on this. Looking internationally at banking regulation, are we considered laggards or leaders or somewhere in the mainstream on responding to climate change?
I would say we're with our international counterparts and other supervisors and central banks in identifying climate change as an emerging risk to banks and to financial stability, and we're all learning from each other, I would say.
Thank you. And as you participate in forums that are funded, for example, by the financial services industry and so on, do you spend a lot of time looking at the details of who is funding the different forums, or do you look at the quality of the ideas presented in those forums?
Well, I think we spend the most attention in the international forums on the content of, what can we learn from others. We do pay attention to who funds different forums, and we have, ethics rules around things like that.
Now, the climate change is only one of the future risks that we have to to look at? You know, are there, obvious examples are like artificial intelligence. You know, if I was worried about a credit union that provide financial services to actors and Hollywood screenwriters, I might be very worried about my financial health in the coming years due to artificial intelligence, or just these life extension therapies that mean it's very likely that many more Americans are going to be outliving their financial savings, their life savings. You know, things like these technological threats are coming at us. Is there a general risk framework where you prioritize the different future risks, or do you handle these on a sort of one-off basis? I'll try Mr. Coleman on that.
Thank you for that question. At the OCC, we are focused on the safety and soundness of the institutions we supervise. Dating back to 2014, when the OCC implemented our heightened standards regulation, which addresses risk management frameworks for the largest, most complex banks that we supervise. That lays out our expectations for any type of emerging risks, whether they're internal or external, that could impact the risk profile of the institutions. We also work with our National Risk Committee to better understand the emerging risks that our examiners are seeing in the field and how we need to address those. If you refer to our most recent semi-annual risk perspective, you'll see we've been focused on a variety of risks, including liquidity, compliance, operational, and credit risk. So we take a holistic approach looking at these and apply an approach to ensure that we're taking a risk-based assessment of these risks and how they could impact the institutions we supervise.
Yeah, you also have to consider exogenous risks that don't come from management practices inside the banking industry, but also things like pandemics. There's a long list of things that could really disrupt. Is there an ongoing process that says here is our list of tail risks that we're worried about? Here is what our current evaluation of how we should prioritize them. What is there? Is there a general procedure here, or is this a sort of you handle them individually?
Yes, there is. That's part of our National Risk Committee process, and we publicize the findings of that National Risk Committee twice a year on our semi-annual risk perspective.
Do you remember offhand what the top 5 risks are that do you rank the risks that you're worried about coming at us?
In the most recent semi-annual risk perspective, the top 4 risks that we identified were liquidity, compliance, operational, and credit risk to the largest institutions.
Okay, but I was referring to sort of exogenous risks of things that can come get you, or do you view that actually most of the real risks that you're facing are self-generated by the banking system?
No, we consider risks from the outside. So, for example, cybersecurity risks, the impacts of digital technology, and also climate-related financial risk is included in that semi-annual risk perspective.
Okay, I guess you've probably cost me another late night reading your latest report, but thank you for that. Let's see. I was wondering, is the anti-ESG legislation, is that something that's happening, internationally, or is that sort of a peculiarity of the United States? Is anyone familiar with any other country which is doing this?
I am not. As far as I know, it's just here in the United States.
Okay, that would be interesting, and if anyone has more details on that, I'd be interested. Well, thank you, and my time is nearly up, and I'll yield back.
Gentleman yields. Gentleman from Missouri, Mr. Luchtenmeyer, the chairman of the National Security Subcommittee, is now recognized.
Thank you, Mr. Chairman. Mr. Gibson, Dr. Gibson, Chairman Powell has often said that the Fed will not be a climate policy maker. A little while ago, the chairman was talking about the NFGS, and it has in their statement a purpose here, the express purpose of mobilizing mainstream financial support to transition toward a sustainable economy, which includes directing capital to green and low carbon investments. Mr. Gibson, is the Fed committed to promoting green energy as the NFGS mission states, or is it committed to not promoting green energy as Chairman Powell claims?
So we do participate in the NGFS and the other international groups, but we make policy based on our own domestic mandates and in the best interests of the United States. So,
well, do you think it's in the best interest then of the Fed to stop its involvement if you're not going to support their mission?
Well, our main benefit of participating in organizations like that is to learn from others and other.
That's not a very good answer, sir. If you're going to be a participant, you're either going to be with them or against them. to sit there for information, you go read their position papers to get that. Mr. Powell and the Fed needs to do one or the other, either get involved with that agency or get out of it.
So the standards that are agreed to by international organizations like
Well,
the
then again,
NGF
we shouldn't be listening to standards for international organizations. We're the United States of America, we have the largest economy in the world, the best banking system in the world. We don't even have somebody else telling us how to do our job. So, sorry about that. I just can't believe that this is where we're headed. I find it also troubling that supposedly independent bank regulators are now trying to insert partisan climate policies under the guise of helping financial institutions understand and guard against climate-related financial risks. Under the Obama administration, FDIC Chairman Gruenberg was godfather and creator of Operation Choke Point. He led and directed FDIC work hand in hand with the Obama administration, pressuring banks to cut off or reduce financial services to businesses liberal progressives and President Obama didn't like. We found out about it and we stopped it. To me, this seems like a disguised version of Operation Choke Point, where regulators are again picking and choosing what industries have access to banking services and credit. Ms. Eberley, how is this not different from a different way of achieving the goal Mr. Gruenberg and President Obama set out with Operation Choke Point?
At first, I would note that Operation Choke Point was a Department of Justice initiative, and our Office of Inspector General indicated that
Ma'am,
any involvement of
I'm in the middle of Operation Choke Point for 4 or 5 years. I've got a copy of an email from Mr. Gruenberg talking about this, so don't go there.
Okay.
Now, can you answer my question or not?
I will answer your question. I will tell you that our policy is clear and it hasn't changed, that institutions that can properly manage customer relationships and effectively mitigate risks are neither prohibited nor discouraged from providing services to any category of customers or individual customers operating in compliance with applicable law. And we have processes in place to provide transparency and accountability around our policy. And our focus on encouraging financial institutions to consider climate-related financial risks in a manner that allows them to prudently meet the financial needs of their communities.
Thank you for that. You can send me your written statement there if you're going to read something that you've got written down. Dr. Gibson, by its own admission, the Fed has said climate-related financial risks are not fully understood, measured, or modeled. Why should the American people be comfortable with the Fed putting forward the idea that it can now monitor and help banks manage climate-related financial risks when you cannot even effectively monitor and help banks manage the basics like interest rate risks?
So our supervisory mission is to ensure that banks are operating in a safe and sound manner and managing all their material risks. And so for us, that definitely includes the traditional banking risks as well as the emerging risks, climate-related financial risks.
It's interesting you talk about managing all your risks. You know, a while back we had an asteroid that almost hit the Earth. It came close to our atmosphere. I suppose you probably weren't managing that risk. We have a volcano that exploded last week, ash 40,000 feet in the air. It's going to affect us somehow, some way. I don't know if you guys are measuring that risk or not, but volcanoes do go off as well. You know, we have a smoke from a fire up in Canada. It's affecting how people are doing business and living in this country right now. Are you guys managing any of that risk as well? Those are all definite risks that are here today. Did you foresee those things? Or are you managing those risks? Anybody? No. So we have a risk here that we think we have. I have a letter here from, or article here from the Manhattan Institute that talks about, let us state a plain and obvious fact. Climate change is an important challenge, but climate change poses no measurable risk to the financial system, not individual banks, but to the system. The emperor has no clothes. And with that, my time is up, but I think the
Gentleman's time has expired. The gentleman from California, Mr. Sherman, is now recognized.
I'm concerned that a number of our states, for political reasons, are cutting themselves off from major financial institutions. They'll end up earning less money on their deposits and paying higher fees and costs when they issue bonds. I agree with Mr. Lukemeyer. We cannot see a return to the Operation Choke Point, and I'm concerned that bank regulators talk about reputational risk. Reputational risk should be factored in only when the bank is providing services to someone who's doing something illegal. But if we decide that there's a reputational risk to a bank for having a bank account for a customer that is very unpopular, then every time we have a Democratic administration, A gun manufacturer won't be able to get a checking account, and every time we have a Republican administration, Planned Parenthood won't be able to get a checking account. We don't want that kind of, with all due respect to the fine witnesses that are here, we don't want to give you that kind of political power, nor should we. If you want to make gun manufacturers illegal or Planned Parenthood illegal, the way to do it in democracy is pass a law in Congress, not prevent them from having a bank account. We have a policy in this committee that we mark up legislation only after we've had a hearing on that legislation. There are a number of bills that are listed as part of this hearing that really don't have much to do with the topic of the hearing, and that seems to be a possible loophole or a run around the rules of the committee. And I do want to agree with Ms. Eberley's comments on Operation Choke Point. Do we, would it make sense for us to be concerned about a bank's prudential risk, Ms. Eberley, if they lent all their money to the Quebec Fire Insurance Company or to other similarly situated fire insurance companies as fire risks are going up?
You know, any kind of concentration risk that an institution has is something that an institution has to manage. We have longstanding instructions that are public on our website as part of our manual of examination
And
policies.
If you're
Instructions.
concentrated in something that is less risky, is that less of a risk than being concentrated in something that is increasingly risky?
It would be. You have to take into account the range of risks that could manifest from having a concentration in any kind of business line.
And we just went through a process by which banks ignored the fact that we had that interest rates could go up and probably would, it felt good to say interest rate, inflation is transitory and interest rates aren't going to go up, but there was a real possibility that they would. Thank God, our blindness on that was not fatal. We now have a climate risk. We shouldn't blind ourselves to the warming planet any more than we blinded ourselves to inflation and interests going up. Mr. Gibson or Dr. Gibson, do we expect that those things that are affected by rising temperatures will become more risky?
I think we're concerned that climate-related financial risks are an emerging risk that we don't know enough about, so we need to learn more in order to be able to answer questions like their
And I would point out that we also ought to be looking at the China risk. There is a significant possibility of a rupture in that trading relationship, and many of the borrowers are very dependent on the China distribution chain. So this may be the only, this month at least seems to be the only topic of our committee. This is, I think, our 412th hearing that has something to do with ESG just this month. But I hope you're looking at other risks as well, including the China risk, and I yield back.
The gentleman's time has expired. The chair now recognizes himself for 5 minutes for the purpose of asking questions. Dr. Gibson, I'd like to kind of continue on with some of the questioning that Mr. Barr and Mr. Lukenmeyer did regarding the pilot climate scenario analysis that happened earlier this year. Specifically, the exercise instructions make repeated references to the board's involvement throughout the process. In fact, the instructions say that the board designed the pilot CSA exercise. The board will engage with participants, and the board anticipates publishing insights. All of this to say the pilot CSA instructions seem to indicate that the plan actually originated with and has the support of the board. So the first question, did the Federal Reserve Board vote in support of conducting the pilot CSA?
The full Board of Governors did not vote on the climate scenario analysis because it's purely an exploratory exercise.
So there was no vote. You said the full board did not. Does that indicate that maybe some individual members, are you saying there was no vote at all?
I'm saying that the board didn't vote on the climate scenario analysis exercise because it was purely exploratory, because of its exploratory nature.
Okay, but so the short answer is no, the board did not vote.
No, the board did not vote.
Okay. Which board members have been working on the CSA exercise?
So the exercise is being conducted by the Federal Reserve's staff under the direction of Vice Chair for Supervision Barr, and he keeps the other board members informed about the progress of what we're doing in supervision.
So you're saying, other than Vice Chair Barr, no one on the board has been engaged in working with the CSA?
I mean, the other governors have been informed about it, but the actual work is being done by the staff.
Why would the instructions then say the board designed the pilot CSA exercise? The board will engage with participants and the board anticipates publishing insights. But what you're drawing is a scenario that the board was separate from all of this, but yet the instructions tend to indicate the opposite.
I mean, I'd have to look at the instructions, but I think they're using the word board as a shorthand for Board of Governors of the Federal Reserve System, meaning the entire agency.
Okay, I would appreciate it if you could look into that because, I think that's a question that needs further exploration. Is the instructions indicate that this is originating from the board, but what I'm hearing from you is that isn't the case. So I think we need to get to the bottom of it. I'll move on to another question then. The pilot CSA promotes scenarios using models from the network of central banks and supervisors for the greening of the financial system. So where does the funding for these models come from?
So the pilot climate scenario analysis exercise uses a range of scenarios. It does use some of the scenarios that were developed by the NGFS as an input. Those are common scenarios that are used by banks in their own internal risk management. So when we were designing the scenarios for the pilot climate scenario analysis, it was easiest to use scenarios that banks were already familiar
Are
with.
you getting to the funding aspect? The question was the funding of the scenarios and models. Where was,
I don't know anything about the funding, but the NGFS publishes the scenarios on their website, so the banks use them from the website.
okay, so you don't know where the funding for this comes from. So does the board formally endorse these models and scenarios produced by the NGFS?
The scenarios are just intended to capture a plausible range of future outcomes. They're not a forecast or a prediction.
Okay, I know you guys have been really prepared on this, but I think y'all are skirting around these questions. Does the board formally endorse the models and scenarios produced by the NGFS? Or is that something you're considering? Is this?
I don't think we've endorsed them, but we are using them as part of our pilot climate scenario analysis.
Okay. I see my time is running short, and so in the interest of giving others the chance to come in, I don't think I can get into some of these others. I'll submit the rest for the record, and I yield back. And the chair recognizes the gentleman from Texas, Mr. Green, for 5 minutes.
Thank you, Mr. Chairman. I thank the witnesses for appearing, and I would like to assure the witnesses that you're doing the right thing. I don't want you to have any consternation or reservation about your fiduciary duty and about how you're carrying it out. Here's some intelligence that I think will provide us a better view of what's happening. More than 80% of U.S. investors said that companies need more openly communicate, to more openly communicate the risk around ESG-related factors. 73% said they are more likely to invest in a company that shares with investors its plans to effectively manage these factors. The people want to know what's going on, and they want to know what's going on, these investors, because in Houston we had a flood of biblical proportions. over 1 trillion gallons of water. We currently have raging wildfires that could rival even what Dante created in his mind. We have insurance companies that are leaving Florida and California, major companies, because of climate-related issues. You have a fiduciary responsibility. You have a legally required obligation to do what you can to make sure investors are aware of what they're investing in. And now, I believe this, and I believe you believe this, but if you agree with me that you have this fiduciary responsibility, would you kindly extend a hand into the air? If you believe you have a fiduciary responsibility, please extend a hand into the air. Only one person has a fiduciary responsibility. So the rest of you are not fiduciaries. You don't have a responsibility to make sure that you provide proper intelligence to people who are investors.
I would say our mandate relates to supervision of banks and making sure that banks are adequately managing their risks, including climate-related
So does that make you a fiduciary?
I'm not sure what the word, I'm not sure what you're asking.
Well,
about
let me
fiduciary,
ask
but
this.
we are responsible for ensuring safety and soundness of
All right,
banks.
let's replace it with responsible. If you believe you're responsible for providing investors good information about climate, material risk associated with it, would you raise a hand, please?
So Congressman, I just wanted to explain why I'm not raising my hand.
All right, please.
And it's because, credit unions are nonprofit cooperatives, not private companies that have stock investors and the like. So that's the reason I'm not
Well,
raising my hand.
do you
But
believe you have
I'll
a-
say I have a fiduciary responsibility to the share insurance fund and the credit union system to ensure that they're resilient and operate in a safe and sound manner.
And in doing that, your investors, as it were, the people who
The members
deposit,
of the credit unions.
they are
yes,
protected.
Yes.
I would say we have a responsibility to ensure that banks are adequately measuring and managing their risks, including climate-related financial risks. We definitely have that responsibility.
Okay, now I don't know how that differs from what I've been asking you, but let's go on, please.
I would say we don't have responsibilities around banks' financial disclosures. And so the question about disclosures to investors, presumably shareholders, was how I was
Not to
understanding your
investors
question.
necessarily, but to those that you have the supervisory authority with to make sure that they are considering the climate issues that are material.
It's our responsibility to make sure that banks are considering the risks that they face and that they're managing those risks properly, yes.
So as to those banks, you have a responsibility. All right.
Yes, we have a responsibility to ensure the safety and soundness of the institutions we supervise and that they are properly identifying any emerging risks. It is the banks who've initially identified this emerging risk dating back several years, and we are using that information to better understand how those risks could impact the financial stability of those institutions.
All right, so let me ask this way. Do you believe that you have a responsibility to understand and communicate the material risk associated with climate change as it relates to your various areas of endeavor? Do you believe you have that responsibility?
I would say it just slightly differently, but we have a responsibility to make sure that banks are understanding the risks that they're facing and that they're managing them.
All right. Do you believe that those that you regulate have the responsibility to understand the risk that they have to deal with?
Yes, sir.
Okay, if you believe this, raise your hand. I want to capture this picture. Thank you.
The gentleman's time's expired. The remaining witnesses can respond for the record. The gentleman from Tennessee, Mr. Rose, is now recognized for 5 minutes.
Thank you, and I want to thank Chairman Barr and thank our witnesses for being here to participate in this hearing today. Mr. Gibson, one of the justifications Vice Chair Barr has given for increasing capital requirements on U.S. banks is because the Federal Reserve is implementing Basel III. Mr. Gibson, do you attend and represent the Federal Reserve in any Basel meetings and negotiations?
Yes, I do.
And Mr. Gibson, is your position or that of Vice Chair Barr that you take when you go to negotiate on behalf of the U.S. at Basel agreed to by a vote of the Federal Reserve Board?
The standards that are discussed in Basel aren't binding on the Federal Reserve, so the board votes on regulations that it proposes under its domestic mandates.
Thank you. Mr. Gibson, has Congress recognized the Basel Committee as an international organization that should have standing to dictate regulatory rules that can have major impacts on the U.S. economy?
I don't know about Congress, but we don't implement standards that come from the Basel Committee just because they're agreed to in Basel. We would go through a domestic rulemaking process following our domestic procedures.
I'm just concerned that what is actually happening is that Vice Chair Barr, with the select few staff, can go to Basel, to the committee, and negotiate major initiatives that have significant impacts on the U.S. economy, and then come back and use that as a rationale to adjust capital requirements. Mr. Gibson, New England, New York, and Pennsylvania have all seen greenhouse emissions rise following the closure of nuclear power facilities. As a member of the Network for Greening the Financial System, does the Fed believe that cutting nuclear power increases or decreases the risk in the financial sector?
I don't know that we have a view on that particular question. Our responsibilities with respect to climate-related financial risks are narrow but important.
Okay. On June 21st, 2018, climate activist Greta Thunberg tweeted that, quote, "A top climate scientist is warning that climate change will wipe out all of humanity unless we stop using fossil fuels over the next 5 years." Ms. Benatar, it's been 5 years since that pronouncement. Yes or no, has climate change wiped out all of humanity?
I have a duty to my constituents, and in my community, we have seen record floods, record fires.
But I think it's safe to say that we're all still here, absent the normal tragedies that happen to humanity and humankind. And so the pronouncement obviously was over the top and not true. And, you know, whether or not human activity is affecting the climate or not remains an area of active interest and something that we should continue to be vigilant and aware of. But we also know the history of the world, or at least we can surmise from the data that we have, and we've seen the entire planet melt off and be without ice. We've seen it virtually frozen over. All of that happened in a time when human activity wasn't occurring. And so, you know, one of the hallmarks of the development of human civilization and the humankind is that we've managed to adapt to the changes. And so while we ought to be careful about what we do, I think going all the way back to the pronouncements of Malthus a few centuries back, we ought to be mindful that sometimes we don't have proper perspective. And I'm just curious what your reflection on that question was. Mr. Jones, what would you say has been NCUA's experience with credit unions that are CDFIs and are grant recipients, CDFI grant recipients, over the last 12 months? And has NCUA received feedback about the application and certification process?
We have received feedback. I would like to say that the CDFI process is run by the Department of the Treasury. We do understand that some credit unions have had some difficulty. Our chairman has engaged directly with the Department of the Treasury on that because we have an interest in ensuring that credit unions have access to CDFI funds and remain available to help their members.
Thank you. I appreciate that. I yield back.
The gentleman's time has expired. The gentlewoman from Ohio, Ms. Beatty, is now recognized for 5 minutes.
Thank you, Mr. Chair and Ranking Member, and thank you to the witnesses for your patience here with us today as we explore this. My first question will go to you, Madam Treasurer Benatar. Like many of my colleagues, I represent a great deal of banks and insurance companies and other financial institutions that certainly, as you know, provide financial services to consumers across the country. It is my opinion that these institutions are already taking climate related financial risk. By your own words as experts, you have said in relationship to climate related risks, they are extreme, they are emerging, they are rising risks. Could put our institutions at issue. We are still evaluating the situation. Most people must learn to understand, and it is trending nationally. So with that, to me, it makes good business sense to take these factors into consideration because these institutions also have been very vocal in their opposition to state-level Republican-led bills that limit the use of climate-related factors in their businesses. Can you discuss for me why financial firms want to consider these risks and why it's good for the bottom line?
Thank you for the question. For us, it's about our taxpayers. It's about our constituents. We all represent our constituents back home. And at the end of the day, if we are not including those climate risks, if these financial institutions are not including this in their analysis of whether they even want to loan money to my fire district, do they want to risk loaning money to a government entity if there's fires and flooding happening in that community, knowing that costs will go up, without understanding what I'm doing as a fiduciary to address those issues? That's something that I am being asked by our financial institutions when we talk about credit lines, for example. But I should also be asking the same thing when I'm looking to who I do business with, but I should be managing it. Prior to me being treasurer, we had seen flooding and fires that did take lives in my community and houses. We were not prepared for that. We had to sell at a loss, and I don't want to do that again.
Mr. Jones, can you discuss the impact it would have if climate-related multi-billion-dollar risks are ignored? How would it affect lending or credit unions and business?
Sure. In our preliminary research, we determined that roughly a third of credit unions are located in communities that are at relatively high or very high risk from natural disasters. And minority depository institutions, it's about half of them.
That was going to be my next questions to talk about MDI.
I didn't mean to get ahead of you. I'm sorry.
That's great.
So and it's particularly, like I said, profound with minority depository institutions. And so because of that, in the agency's view, credit unions really know their communities well, but our interest is in learning about it. But so I think that credit unions really have to pay attention to these risks and any other risks that could be material.
Okay. That gives me a different focus I want to go on. And you can thank Mr. Jones, Mr. Gibson, for your next question. Research shows us that the impact of physical and transition risk are uneven across locations, income, race, and age. This is due to geographic reasons as well as regions' ability to adapt to these risks. The natural progression of this thought process is that efforts to adapt to climate change and take these risks into consideration would also have an effect on existing inequality. What are your thoughts on this, and how is the Fed taking these inequality implications under consideration?
So our supervisory perspective is really around ensuring that banks are measuring and managing all their material risks, including the climate-related financial risks that you asked about. It certainly could have broader effects on things like inequality, but really what we're looking at now is how banks are developing their capacity to really measure and understand these risks. So we see firms investing in data and models to better understand the factors that you're asking about. I think we all still have a lot to learn about what the impacts will be.
Thank you, Mr. Chairman. My time is almost up, so I yield back.
The gentlelady yields. The gentleman from Texas, Mr. Williams, is now recognized.
Thank you, Mr. Chairman. The Federal Reserve has established a pilot climate scenario analysis exercise. That's a lot of words for a guy from Texas. which requires 6 of the largest banks to major and manage climate-related financial risk. This requirement is extremely out of touch and increases burdens on financial institutions, and the Vice Chair for Supervision, Mr. Michael Barr, has taken the lead on this initiative without a vote from the board and claims that the exercise will support the board's responsibilities. But climate regulation is not a part of these responsibilities. This is a slippery slope and shows that the priorities of the Federal Reserve are shifting towards greenwashing our financial system, which is ignoring true risks like debt limit impasses and unsustainable federal spending leading to a higher national debt. So, Mr. Gibson, a few months ago, when Chairman Powell was testifying before this committee, he said that the Federal Reserve is not and will not be a climate regulator. Do you believe that the Federal Reserve should be or should not be a climate regulator? And is this climate scenario analysis part of the Fed's holistic review for increasing capital requirements?
So I agree with Chair Powell that the Federal Reserve is not a climate policy maker, and the pilot climate scenario analysis exercise won't have any implications for banks' capital, so it's different from the holistic capital review.
Good. Now, the FDIC, Federal Reserve, and OCC have all issued their own draft principles for climate-related financial risk. These are all policies that should not be decided by independent regulators. These principles are taken straight out of the Biden administration's hands in an attempt to promote policies via banking regulations. Regulators cannot be truly independent if they regulate from the Biden playbook. One such principle proposed by the Fed suggests that a bank's board of directors should consider tying compensation policies to risks that are associated with the climate change, and decisions like compensation should be made solely by the board of directors and should not be influenced by any outside parties. So financial regulators have an obligation to stay truly independent of the political arena and by getting involved. Mr. Coleman, you are jeopardizing the OCC's credibility in becoming proxies for the Biden administration radical climate groups. So is the OCC following the direction of an executive order, the FSOC, or other interest groups to insert climate-based policies into bank regulations? And does the OCC principles ask bank boards to consider tying compensation to climate change measures?
Thank you for the question. The OCC is focused on the safety and soundness of the institutions we supervise. We are not focused on social or environmental issues. We are simply focused on ensuring that these climate-related financial risks are identified, properly managed, properly monitored, and controlled. We issued the principles with the idea of providing feedback based upon information we'd received from the institutions that we supervise dating back as early as 2019. With them raising issues with us about how they should manage those risks and how they should properly identify those risks consistent with our expectations for a risk management framework.
My last question here briefly is financial regulators should not be in the business of picking winners and losers. We see that with this administration constantly, but unfortunately now they are. Now these actions are being made under the disguise of transitioning away from reliable energy like oil and gas and channeling credit towards green energies. So by following the lead of international agencies and pressuring financial institutions to adopt climate-related policies, regulators are fixing the market and abandoning all of the above approach. U.S. energy needs cannot be met solely by renewables, and regulators should not be in the practice of giving one energy sector an advantage over the other. Remember, I'm from Texas. So, Mr. Gibson, has the Federal Reserve been facing pressure to channel credit away from certain energy sectors and moving it towards green sectors?
So it's not the Federal Reserve's policy to discourage banking organizations from offering accounts or services to any class or type of law-abiding business.
All right. If you would just stay with what you're designed to do, small business guys like me can survive. I hope you do. I yield back my time.
The gentleman yields back, and now the gentleman from Illinois, Mr. Keston, is recognized for 5 minutes.
Thank you, Mr. Chairman. I want to start just with a little bit of history to level set us. For the vast majority of human history on this planet, atmospheric CO2 was pretty stable at about 260 parts per million. It started going up during the Industrial Revolution. Took about 200 years until I was born, 1971, after the Industrial Revolution started, by which point it had gone up about 80 parts per million, was then at 320. In the 51 years I've been on this planet, it's gone up by another 100 parts per million because of all the fossil fuel burn. 50% of all the CO2 we have ever emitted as a species has been since I graduated from college in 1993. Do you all agree that anthropogenic combustion of carbon is the primary cause of global warming? Yes or no? Does anybody disagree with that? Okay, I'm happy to have the silence, because last Wednesday, one of my Republican colleagues on this subcommittee said in a hearing, I know a comment was made about belief in anthropogenic global warming or climate change or whatever you want to say it is. I don't think the science is settled. This is obscene. If you had a member of Congress who said, I don't believe in the laws of gravity, we would go out of their way, out of love and respect for them and their family, to keep them away from the speaker's balcony. And yet in today's Republican caucus, denying laws of physics puts you on a path to leadership. Let me now shift to areas under you all's jurisdiction. In October of 2021, the Financial Stability Oversight Council's report on climate-related financial risk, which you are all members of, with the exception of you, Ms. Benatar, for the first time identified climate change as an emerging threat to U.S. financial stability. Do all of you believe that the physical and transition risks from climate change can threaten financial stability? Yes? Nods across the board. I say that because we are here with people criticizing you for doing too much. I think there's a fair criticism that you're not doing enough. Dr. Gibson, I've talked to some of your colleagues. We're seeing huge movements of capital from the insurance industry. Parts of Florida, parts of California, parts of Louisiana no longer being insured. If we are only going to limit our examination of financial risk to the banking sector or to the 6 big banks, we're staying blind too long to the larger disruptions in our economy. And I think we need to do much more than we are doing to make sure that we protect folks. But that's a longer conversation than we have time for in the time here. Treasurer Benatar, you are trusted to safely and prudently manage the public's money. Do you have a responsibility to evaluate all risks?
Absolutely. I have to evaluate all risks. And just want to say, right now in Arizona, we are seeing the heat.
No doubt.
No doubt.
And are the anti-ESG bills that are being passed restricting your choice?
Absolutely.
You mentioned in your testimony some of the costs of these bills, $6.7 billion in Indiana, $3.6 billion in Kansas, $70 million in Kentucky. Who is bearing the brunt of these costs?
Our taxpayers, your constituents.
And the firefighters and the policemen and the pension holders and everybody who
Absolutely,
depends
and our
on
taxing
us.
districts.
Now, you're the minority witness. I say that with love and respect. There are folks from very Republican areas who completely agree with you. In Kentucky, the board chair of the Kentucky County Employee Retirement Fund system said the anti-ESG law is inconsistent with its fiduciary responsibilities with respect to the investment of assets or other duties imposed by law. In Indiana, an official from the Indiana Chamber of Commerce, not a lefty woke organization, said, we believe the anti-ESG bills are anti-free market and anti-free enterprise. Is anybody listening? My God. In Texas, executive director of the Texas County and District Retirement System said, we have concerns that the anti-ESG bill could impair our ability to maximize our returns and have a financial impact for our employers. This is real stuff. Fiduciary, thank you, Madam Ranking Member. Now look, all of us on this side of the dais have the privilege of writing laws. We get to debate laws. We get to argue about what should be in those laws. It is a tremendous responsibility. It's a tremendous duty. I still pinch myself every day that I get to do this. That power does not extend to the laws of physics. It does not extend to the laws of capitalism and free market economics. We have the ability to ignore them. We have the ability to write a law that says, go to the speaker's balcony and jump. We have the ability to write a law that says, let's destroy free markets. Let's make the U.S. no longer attractive to innovators and entrepreneurs and make us the envy of the free world. Let's stop all that by ignoring the laws of economics, by opposing free markets. Just because we have that power doesn't mean that it's our obligation to use it. I've been saying this all ESG month. I really hope that it someday, once again, becomes bipartisan to support competitive markets and the laws of physics. I yield back.
Gentleman yields. Gentleman from Wisconsin, Mr. Fitzgerald, is recognized for 5 minutes. Smaller room.
Thank you, Mr. Chair. On September 29th, 2022, the Fed established the pilot climate scenario analysis exercise to measure and manage climate-related financial risks. However, the covered institutions already measure relevant financial risks and do not need enhancement and help promised by the Fed. I'm not an accountant, but I had a roommate in college that was, and he was studying to be an accountant. And I just remember the basic principles of accounting, which was a book about this thick. It was very principled. There's certain things you do when it comes to accounting and certain things you don't. There's certain things you consider and other things that you would never consider. And my colleague who just spoke kind of reminded me that, you know, when it comes to ESG, or as he framed it, ESG month, there should be some variance in there. And I've always thought, not only as a state legislator, but now as a member of Congress, that, you know, there are certain things we can do voluntarily that if we want to move forward, if we have questions about the environment or social governance that are important, I think that should be factored in. But it shouldn't change the basic principles of the way the boardroom works. And I think that's why, not only in this committee, but in other committees that I serve on, the focus on ESG is because we don't know what the impact would be if we kind of change the rules of where we're at on many of these things. So the Fed has stated that increased capital requirements form the holistic capital review, and the Basel III endgame requirements will be implemented in the long term. So to Mr. Gibson, does the perceived long-term implementation of increased capital requirements contemplate the potential to turn climate scenarios into regular climate stress testing?
That's not part of the current work plan, no.
And have there been any discussions about increasing capital requirements on banks over the next several years, and then doing so again under the climate stress testing regime?
No, the climate scenario analysis exercise doesn't have any implications for capital requirements.
Right. And in January 2023, Federal Reserve research paper titled, "What are the large global banks doing about climate change?" the authors wrote, "Our paper is closely related to a report by Influence Map 2022. Influence Map is a London-based think tank devoted to the mission to, quote, hold the corporate and finance sectors accountable for climate performance." I mean, it's just a completely separate agenda from what anybody should be considering when it comes to finance. And in attempts to use the name and kind of these shame tactics and the way it's funded by several entities, including Climate Works Foundation, which in turn is funded by several entities, including Bloomberg Philanthropies, the Chan Zuckerberg Initiative, and the High Tide Foundation, amongst others. There's an agenda there. There's absolutely an agenda, and if we don't look at this clearly, I think we're all going to fall for this game of propaganda and a movement away from what I said earlier, the basic foundation of accounting principles. So to Mr. Gibson, is the Federal Reserve following the lead of outside international think tanks and advocates and activists of climate policy change in efforts to try and pressure or push financial institutions toward climate policy directions right now?
No.
And the final thing I'll just say, because I'm going to run out of time. There is absolutely a pressure. I've spoken to CFOs and to CEOs, and sometimes they're even unaware how their own corporations have responded to this. I remember we had a dinner that I attended in which I asked the CEO, tell me what you think about CSG. And he said, oh, it's not something we're involved in. It's not something that we talk about at any of our corporate meetings. But the fact of the matter is, 2 days later, I had a staff person come to me and say, look at the website. Their website had a full 2 pages on ESG. So it really raised a question in my mind, are some of the corporate leaders even aware of kind of what's going on, even within their own companies? I think the answer to that is no. I yield back.
Gentleman's time has expired. The gentlewoman from Massachusetts, Ms. Presley, is now recognized.
Thank you. Thank you to our witnesses for joining us today. From the scorching heat in the south to the historic flooding in the northeast, including in the Commonwealth of Massachusetts, which I represent, it is clear that time is really running out to avoid the worst effects of climate change. Now, 4 of our witnesses here today represent federal agencies who sit on FSOC. The report that you put out 2 years ago stated that, quote, climate-related financial risks will become more acute if not addressed promptly. Now, while it is certainly encouraging to see your agencies take the risks of climate change seriously, 2 years later, it is very discouraging. That's probably the understatement of the year, that Republicans in Congress and on this very committee are obstructing efforts to prevent and mitigate devastating harm to working families and to our economy. As my grandmother used to say, denial is not just a river in Egypt. Mr. Coleman, the OCC's mandate focuses on the safety and soundness of the financial system. When it comes to climate change, if a bank has weaknesses in its risk management system, obviously this could adversely affect not only a bank's safety and soundness, but also the overall financial system. So yes or no, in light of this, do you agree that the OCC has the authority and is in fact obligated to address those risks?
The OCC is obligated to address climate-related financial
Yes.
risks, just as we are with any emerging risks.
So yes or no?
Yes.
Thank you. This past weekend, we saw heavy rain and flash flooding in my district, the Massachusetts 7th, and just last week, flooding in the region in Vermont caused the OCC to allow financial institutions to close. As climate change continues to cause more and more physical damage to our communities, we see more financial institutions close in frontline communities for the very same reasons. However, the people who are the most hurt by these closures are low-income, working-class families, especially when it occurs at a time when they may need financial services the most. Mr. Coleman, what steps is the OCC taking to ensure that financial institutions can continue to serve their communities through growing climate-related financial risks, like the flash flooding that my constituents experienced last week?
Thank you for the question. Our focus at the OCC is on the largest, most complex banks with over $100 billion in assets and how they are addressing climate-related financial risks. In terms of community banks, we believe that these community bankers, they've operated for decades in their communities. They are very familiar with the impact of weather-related events on their communities, on their businesses, on their local clientele. We think they have the best knowledge of how to meet the needs of those communities. In addition to that, our acting comptroller has made an effort to get out and meet with community bankers to make certain they are aware of our efforts and make certain they are aware of what we are doing as it related to climate-related financial risk.
Thank you. I request unanimous consent to enter into the record a recent working paper from the European Central Bank titled "The Impact of Global Warming on Inflation."
Without objection?
This paper found that climate change poses risks to price stability and will result in higher inflation, including hiking up the cost of food. Director Gibson, this strikes right at the essence of the Fed's mandate. What steps is the Fed taking to better understand the implications of climate change to price stability and the financial system as a whole?
So my area is supervision. I can really only speak to that. I would say the Fed conducts research on a range of topics, including inflation in other parts of the Fed.
Regulators must not delay action on climate change. Climate risks are growing by the day. Working families bear the brunt of this damage, and we really do need concrete action now to avoid further catastrophe. Thank you, and I yield.
Lady yields. The gentleman from South Carolina, Mr. Timmons, is now recognized.
Thank you, Mr. Chairman. I think it's important to highlight how we got here and why these hearings on ESG are necessary. woke ideology used to be an abstract idea on northeastern liberal arts campuses, but now it's top of mind and it has seeped into many of our government institutions and almost every corner of our society. The Biden administration's woke policies have become their top priorities, committing billions of dollars to climate justice and tree equity. And now corporations feel beholden to the woke mob. Just ask Bud Light what happens when you give in to the loudest voices. As the saying goes, go woke, go broke. Their recent campaign has resulted in a 28% drop in sales, relegating their status as the #1 beer in America for nearly 2 decades, down to #2, and it's in a free fall. Costco just removed them from their sales. Perhaps the silent majority isn't so silent, at least regarding spending their hard-earned money. Continuing on our committee's theme of ESG this month, today's hearing is about how woke ideology foot soldiers now staff our bank regulators and how the Biden administration is using these foot soldiers to push our financial institutions into promoting woke climate policies. When it comes to woke policies, what this administration can't legislate, they will regulate. Mr. Gibson, does the Fed believe that it should follow the lead of the European Central Bank in tying monetary policy, collateral policies, and asset purchase policies to consideration of climate change to help promote green financing and channeling of credit from some sectors to others?
So those aren't things that the Federal Reserve has been doing, no.
Do you think it's something that should happen or that could happen?
So my area is supervision. You're asking questions about monetary policy, so I don't have any knowledge that that's something that the Federal Reserve is doing.
Well, it's not going well for Europe. I hope we don't start it here. By its own admission, the Fed could not even effectively monitor and help banks manage interest rate risks. Why should we be comfortable with the Fed putting forward the idea that it can now monitor and help banks manage climate-related financial risks that, again, by its own admission, the Fed identifies are not fully understood, measured, or modeled? Mr. Gibson, do you agree that it should focus on its main mission and not go into these other areas?
So with respect to supervision, our mission is to ensure that banks operate in a safe and sound manner and manage all their material risks, including climate-related financial risks.
Federal Reserve Chairman Powell has said that the Fed has narrow but important responsibilities to use the oversight of banks to ensure they manage the balance sheet risk created by climate change. For each of you, does your agency also believe that they have only narrow responsibilities to provide oversight of banks to ensure they manage risks and nothing more? Mr. Gibson, I know where the Fed is. Mr. Coleman, I'll start with you.
At the OCC, our mandate is to ensure the safety and soundness of the institutions we supervise and ensure that they are managing all of those risks, including any emerging risks, that is very consistent with the frameworks that we have laid out, including our heightened standards expectations. And the banks have identified, and we've identified, that climate risk and climate-related financial risk is an emerging risk to the institutions.
Do you believe that that's a narrow responsibility, or do you think that that is broad? Do you think it should supersede fiduciary obligations to their customers and to their shareholders?
We are not in the business of telling banks who they can or cannot bank. Our focus is on the safety and soundness of the institutions we supervise.
I wish the Biden administration would agree with you. Ms. Eberley, what are your thoughts?
My thoughts are consistent with my colleagues. Our focus is on the safety and soundness of financial institutions and how they manage the risks that are presented in the areas where they're operating and the customers that they're serving.
And you would agree that a return on a shareholder's investment is the fiduciary obligation of whatever entity we're referencing, and that should be first and foremost.
That's not within our area of responsibility. We're focused on safety and soundness.
Mr. Rendell, what are your thoughts?
The NCUA is focused on the safety and soundness of federally insured credit unions and the National Credit Union Share Insurance Fund.
Thank you. Mr. Chairman, I yield back.
The gentleman yields back. The gentleman from Tennessee, Mr. Ogles, is now recognized.
Thank you, Mr. Chairman, and to the panelists. We're almost there. And we appreciate you being here. Dr. Gibson, the Fed has considered the notion of double materiality in micro and macro prudential supervision The idea is that supervisory authority should consider both the risk that the banks face from climate change, such as more losses if there are more floods, but also the impact of actions by the banks on climate change, such as making loans to some where the activity of the borrower allegedly makes climate change worse. For example, if a bank provides loans to certain sectors deemed to be high greenhouse gas emitters, then supervisors should take that into account and consider actions to channel credit and other financial services toward greener activities. My question, will the Fed be introducing double materiality into its supervisory framework? And if so, how should or how will double materiality be defined?
Our perspective is single materiality, not double materiality.
And so have there been instances where green global warming type of factors have channeled credit away from a business sector and towards others?
So it's not the Federal Reserve's policy to discourage banking organizations from dealing with any law-abiding business, so banks make their own decisions about which customers to deal with.
What about guidance from the Fed? Is there any guidance that would suggest that that's something on the horizon or could be on the horizon?
So we have guidance around safety and soundness and making sure that banks are managing all their material risks. And we have proposed guidance on climate-related financial risks.
But think about the wildfires in Canada, and obviously there's some that would point to global warming as the cause. But then when you look at the news reports, they're not confident that some of the fires may have been caused by lightning, but some of it may have been arson, some of it may have been accidental. And so my concern is when we're kind of lumping into and defining global warming and other kind of ESG climate type of jargon, that we're ignoring the fact that lightning has been occurring for a while and that wildfires have been occurring for a while, and that in areas where we're seeing some of the kind of devastation, we're building in areas that are already high risk, right? And so it's not that the climate has changed. Moreover, it's this, that perhaps we're not managing the fire or the forest appropriately. And so I caution all of the agencies, respectively, to not try to wordsmith or try to achieve an outcome based off of, quite frankly, natural phenomena that have been occurring. The Fed is asking financial institutions to prepare for the possible future climate scenarios where there could be growing financial risk related to climate change. Would you agree a more relevant, recent, and visible risk would be delayed payments from the Treasury securities arising from a cyber attack or other adversities? It would be easy to set up a scenario to analyze where there are, for whatever reasons, delayed payments as a potential risk to the financial sector. Has the Federal Reserve Board asked financial institutions to perform such scenarios?
Scenarios around delayed payments?
Sure. Say there's some sort of cyber attack, some sort of, what other scenarios might you give guidance that you would want to see in addition to the climate risks?
So we expect banks to be managing all their material risks, including cyber risk. We are doing a pilot climate scenario analysis focused specifically on climate-related financial risks, but we're also doing work in other areas like cyber risk to ensure that banks are managing those risks too.
Yes, sir. Now, I guess, one of my concerns that I've had with, quite frankly, many of the alphabet agencies, but, is as we've seen under this administration, an agenda that's permeated the business community. It's been forced upon them. And I would argue that the Fed has been culpable in that agenda. And Mr. Chairman, I'm out of time, but I want to thank the panelists for being here. We are almost done. And again, Mr. Chairman, I yield back.
Gentleman yields. The gentleman from South Carolina, Mr. Norman, is recognized.
Thank you, Mr. Chairman. I want to thank each of the panelists. Let me mention, I know forest fires have come up. Ms. Bellatar, you'd mentioned that. I think one of my colleagues mentioned the problem we have with forest fires, particularly in California. If you talk to any of the forest management team, you know what they say the number one cause outside of lightning and outside of intentionally setting fires, the number one cause is?
I speak daily, and they do say it's arson.
Okay, arson, but what's another?
Well, for our fires, we do lightning, arson, and that's been, the primary causes of fires. And for us, it's growing significantly due to not addressing deforestation issues and not actually doing mitigation control to help stop fires from expanding in our communities.
The number one issue that and we have a lot of natural areas and federal lands in South Carolina, but they mentioned the activists, the thatch is 2 and 3 feet that they will not let you take up, which is a tinderbox for an arsonist. My question at one of the hearings was, do you believe trees have lives? In other words, they're beginning and ending, because the activists I talk with will not let you thin the forest to let the sunlight in, let the air. They just don't believe in that. And for the regulators to cap insurance companies because they can't insure it is ludicrous. How would y'all are in the regulatory industry, how would y'all rank if you had to advise your banks on the risk? Where would climate change rank with, Mr. Ogles mentioned cybersecurity, defaults? How would you rank climate change as a risk to the bank?
Thank you for that question. We don't specifically rank the risks, but as noted in our semi-annual risk perspective, we do highlight what we believe to be the most significant risks facing the institutions today. We highlighted 4 of those risks, including operational, compliance, credit, and liquidity. And within those risks, we highlighted specific things that could impact those risks.
But how would you, if you had to just say, your safety and soundness is your goal to monitor, how would you, when you gave them a synopsis of all the risks the banks face, where would climate change rank, in your opinion?
I believe that is dependent upon the institution, and it is up to the institution to define how climate-related financial risk could impact their financial stability.
Okay, so you give you have no opinion on should they put that top priority, or is a cyber attack, is a liquidity default, is that doesn't come into play when you advise a bank on what could get them out of the safety and soundness realm? Because I will tell you, according to a Pew Research Center polling this year, climate change ranks 17th out of 21st on national issues with the average public. When you hear some of the ludicrous things that are being said, Al Gore saying that the ocean is boiling. He worked himself into a frenzy. I will tell you that what's bizarre now in this country is you got an administration that is best friends and cozying up to a China, which is, I think, building coal plants every week. The CO2 emissions there aren't too good. The issues there, it baffles me that why they're pushing this so much. Secondly, I will say one of the things the Financial Services Committee, and I've talked to the chairman, I think need to do is break down the dollars that are spent. Who is that going to affect? If you can affect a flood, if man can affect the wind, if man can affect a hurricane, where are these dollars? Break it on down, like I do when I have to have a real estate project. Where is this money going? Would that help y'all in evaluating risk to see what your return on your investment is? Okay, I think I get blank stares, but I think that would give you some idea when you find out who's doing what, when you find out where the money's going. I think it'll tell you a whole lot. And for these who think put this risk above everything, not only is it disservice to the shareholders, it's disservice to this country. I yield back.
Gentleman yields. Gentlewoman from California, Mrs. Kim, is recognized for 5 minutes.
Thank you, Chairman Barr. I represent a district in Southern California that is very prone to wildfires because of the bad land management policies from Sacramento, droughts and the impact of climate change. And so I share the concern of climate change, and I welcome opportunities to work together without raising costs for American firms and punishing small businesses with onerous climate disclosure requirements. And we understand the Fed is now undertaking the climate scenario analysis exercise involving a mandate to 6 banks supervised by the Fed. So is the Fed thinking about expanding the pilot program beyond the 6 banks?
So the pilot climate scenario analysis that we're doing this year only includes the 6 banks, and it'll be finished around the end of the year, and then it'll be concluded.
Yeah. You know, so Vice Chair Barr has indicated the findings of the climate scenario analysis will be made public through a report. So does the Fed have plans to incorporate some of what you're learning from the climate scenario analysis into the mandatory stress test using climate risk modeling?
So the supervisory stress test that we do that feeds into banks' capital requirements is separate and distinct from the pilot climate scenario analysis exercise. So those are different things and they don't feed into each other.
So I want to reiterate that we should be careful to not venture out into additional mandates without first ensuring that our field supervisors are taking care of the bread and butter issue like interest and operational risk. Silicon Valley Bank's failure is a clear case study of the negative outcomes because of the lack of focus on the supervisory framework. Mr. Gibson, how involved were you and other Fed staff in conducting this holistic view or holistic review of the capital with Vice Chair Barr?
So a number of the Fed staff worked on projects and briefings for Vice Chair Barr as he was conducting his holistic capital review.
Sure.
Many of us.
When the holistic review was first announced in 2022, it seemed that this review would be conducted by, Fed board. But given the speech from last week, it seems to only be reflective of Vice Chair Barr's view. So that's why I wanted to know how involved was the rest of the board in undertaking that review, and do you foresee including climate risk as part of the holistic review process?
So the holistic capital review was Vice Chair Barr's review, and it doesn't include the pilot climate scenario analysis that we're talking about here today.
Mr. Jones, let me move on to talk about some other issue. The National Credit Union Association's request for comment on climate-related financial risk based on recommendations made by the Financial Stability Oversight Council or any interagency climate working group that the NCUA participates in, that is led by Treasury or another executive branch agency. Is that right?
So the NCUA board did issue a request for information in April of this year.
The NCUA's request for comment on climate-related financial risk asked whether the NCUA should modify its examination procedures and supervisory posture in relation to the risk, including modifying CAMEL's ratings. So could you explain what modifications to CAMEL's ratings the NCUA has in mind, and if it wants to modify its supervision and examination procedures to promote environmental regulations?
So the NCUA board has not spoken to any changes. We asked about 38 questions in the request for information in order to solicit stakeholder feedback on their perspective and what opportunities may exist for credit unions, but there was nothing particular in mind that's been developed. It's really to solicit feedback openly.
Okay. You are continuing to have the conversation, and did you ask, a follow-up question?
So there were a variety of questions that were posed really to try to better understand the physical risks and transition risks along with the business opportunities. The comment period closed on the 26th of June. We've got 44 respondents and we have staff who are going through that right now.
Thank you. I yield back.
Gentlelady yields, and I'd like to thank our witnesses for their testimony today. It's been very informative, and the testimony we've heard certainly, I'm sorry to say, perpetuates concerns that regulators focus on climate-related financial risk will, in fact, politicize credit allocation assurances notwithstanding. And Dr. Gibson, your testimony was very professionally delivered, and I appreciate your service. But if climate scenario analysis is distinct from the capital framework, why are we doing it? We want to know where this is going, and your assurances that your increased focus on climate-related financial risk will not discourage lending by banks to legal businesses certainly looks like to us, some of us, a distinction without a difference. Because when a regulator comes in and says, we're really focused on climate-related financial risk, that sends a message. Don't lend to carbon-intensive industries. That's what we're concerned about. And to the extent it's not happening now, where is this going? And we're going to continue to ask these questions going forward, and we urge you to heed the admonishment of the Chairman of the Federal Reserve. We need to stick to our knitting. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witness for their response. I ask our witnesses to please respond as promptly as you are able. This hearing is now adjourned.